Aryan is a young chap from Lucknow. He regularly invests in stocks and share market, while his father Jay, on the other hand, has been investing in mutual funds for over 7 years now. Aryan recently got to know about how capital gains tax on these two can be saved is now perplexed. For those who invest in stocks and equity mutual funds, the introduction of long-term capital gains (LTCG) in budget of 2018 dampened the mood. So when is LTCG and STCG applicable? Capital gains arise when a capital asset is sold. Capital gains arising on sale of all listed equity shares and equity mutual funds held for more than 12 months are treated as LTCG. In case of unlisted shares, the holding period is 24 months for the gains to be considered as LTCG. When listed shares and equity mutual funds are sold before holding them for 1 year, the gains arising out of that is called short-term capital gains. For debt mutual funds, this holding period is less than 36 months. The only exception here is that for all listed shares or unit of equity-oriented mutual fund or zero coupon bond is that the holding period is 12 months instead of 36 months, and for all unlisted shares or land and building, the holding period is 24 months and not 36 months. So how are the both taxed? LTCG up to 1 lakh rupees in a particular financial year is exempt from tax. LTCG over and above 1 lakh rupees is taxed at 10% without the benefit of indexation. But STCG on equity shares is taxed at 15%. However, dividend income from equity up to 10 lakh rupees in a year is tax-free. Above 10 lakh rupees, this income is taxed at a marginal rate of 10%. Mutual funds provide two forms of rewards: dividends and capital gains. When a company has surplus cash, it may opt to distribute it to its shareholders in the form of dividends. Investors get dividends in the percentage to the number of mutual fund units they possess. The profit realized by investors when the selling price of the securities they hold exceeds the purchase price is known by the term capital gain. Dividends are another method for mutual fund investors to profit from their investments, which are taxed in 3 ways. The 2020 finance law has been amended to abolish the dividend distribution tax. Prior to March 31, 2020, dividend income from investment trusts was tax exempt for investors. In the hands of the investor, the total dividend income is now taxed according to the income tax slab under the heading Income from Other Sources. LTCG and STCG tax on equity mutual funds are the same as it is for equity shares. But where dividends from equity mutual funds are concerned, it is tax-free in the hands of investors, as mutual funds are required to pay dividend distribution tax (DDT) on dividend payout. Something that is worth mentioning here is that the above-mentioned STCG and LTCG rates are applicable only if the securities transaction tax (STT) is paid by the seller. Tax expert Gopal Kedia says there is benefit of deduction in total income of assessee, that is individual or HUF, of up to 1.5 lakh rupees during the financial year available on investing in mutual funds under ATC. On transfer of both mutual funds and stocks, there is a taxability of LTCG at a concessional rate of 10% and STCG at concessional rate of 15%.